Welcome to Invest and Empower. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. Forex trading and currency exchange. Forex trading, foreign exchange trading, and currency exchange are closely related concepts that involve the buying and selling of currencies. Let's explore each of them. Forex trading. Forex trading refers to the speculative trading of one currency against another in the foreign exchange market. It is one of the largest and most liquid financial markets globally, where currencies are traded 24 hours a day, 5 days a week. The Forex market facilitates the exchange of currencies for various purposes, such as international trade, investment, tourism, and speculation. Key participants in the Forex market include banks, financial institutions, governments, corporations, and individual traders. These participants engage in Forex trading to profit from fluctuations in currency exchange rates. For instance, a trader might buy one currency, the US dollar, and simultaneously sell another currency, the euro, in the hopes of making a profit based on the anticipated price movement. Forex trading involves various trading instruments, including currency pairs, where the value of one currency is expressed in terms of another. The most commonly traded currency pairs include EUR/USD, Euro/US dollar, USD/JPY, US dollar/Japanese yen, GBP/USD, British pound/US dollar, and many others. Currency pairs. In Forex trading, currencies are traded in pairs. Each currency pair consists of a base currency and a quote currency. For example, in the EUR/USD currency pair, the euro EUR is the base currency and the US dollar USD is the quote currency. The exchange rate represents the value of the base currency relative to the quote currency. Bid and ask price. The bid price is the highest price that a buyer is willing to pay for a currency pair, while the ask price is the lowest price at which a seller is willing to sell the same currency pair. The difference between the bid and ask price is known as the spread, and represents the transaction cost for traders. Long and short positions. In Forex trading, traders can take two main types of positions. A long position involves buying a currency pair with the expectation that its value will increase over time. On the other hand, a short position involves selling a currency pair with the anticipation that its value will decrease. Leverage. Forex trading often involves the use of leverage, which allows traders to control larger positions in the market with a smaller amount of capital. While leverage can amplify profits, it also increases the risk of significant losses, as losses are also magnified. Market participants. The Forex market is comprised of various participants, including banks, financial institutions, corporations, governments, hedge funds, and individual retail traders. Retail traders can access the Forex market through online trading platforms provided by brokers. Factors influencing exchange rates. Exchange rates in the Forex market are influenced by a wide range of factors, including economic indicators, GDP, inflation, employment data, interest rates, geopolitical events, market sentiment, and central bank policies, among others. Forex trading offers the potential for significant profits due to the volatility in currency exchange rates. However, it also carries substantial risks, and traders should have a solid understanding of the market, risk management strategies, and technical and fundamental analysis before engaging in Forex trading. As with any form of trading, it's essential for individuals to be cautious and manage their risks carefully. Many beginners start with demo accounts to practice trading without risking real money until they gain confidence and experience. Currency exchange. Currency exchange, also known as foreign exchange or Forex exchange, refers to the process of converting one currency into another at an agreed-upon exchange rate. This service is often provided by banks, currency exchange offices, airports, and financial institutions. Currency exchange is necessary for individuals and businesses engaging in international transactions. For example, if you are a traveler from the United States visiting Europe, you would need to exchange your US dollars for euros to conduct transactions within the Eurozone. The exchange rate represents the value of one currency relative to another, and fluctuates based on various factors, such as economic indicators, geopolitical events, interest rates, and market sentiment. It's essential to understand that currency exchange for practical purposes, traveling or conducting international trade, is distinct from speculative Forex trading. In currency exchange, the primary goal is to obtain the desired foreign currency for practical use, while in Forex trading, traders aim to profit from changes in currency exchange rates. Bid and ask price. Similar to Forex trading, currency exchange involves two prices, the bid price and the ask price. The bid price is the rate at which the currency exchange service provider is willing to buy the foreign currency from you, the traveler or customer, while the ask price is the rate at which they are willing to sell the foreign currency to you. The difference between the bid and ask prices is the profit margin for the exchange service provider and is known as the spread. Commissions and fees. Currency exchange providers may charge commissions or fees to their services, which can vary depending on the provider and the amount being exchanged. It's essential to be aware of these costs to get the best deal possible. Exchange rate fluctuations. Exchange rates are not fixed and can fluctuate throughout the day due to various factors, such as economic indicators, interest rates, geopolitical events, and market sentiment. As a result, the amount of foreign currency you receive in exchange for your home currency can vary depending on the timing of the transaction. Practical use. Currency exchange is used for various purposes, such as international travel, business transactions, online purchases from foreign vendors, remittances to family or friends in other countries, and investment activities that involve foreign currencies. Central banks. In some countries, the central bank or monetary authority may influence or manage the exchange rate to stabilize the local currency's value or achieve specific economic goals. When engaging in currency exchange, it's essential to consider the exchange rates offered by different providers and be aware of any additional fees or commissions. It's common for travelers to exchange currency at airports, but rates there may not be as favorable as those offered at local banks or currency exchange offices. Comparing rates and conducting exchanges with reputable providers can help you get the best value for your money when converting currencies. Both Forex trading and currency exchange play crucial roles in the global economy, enabling international trade and financial transactions. However, Forex trading involves higher risks due to the speculative nature of the market, and individuals should exercise caution and knowledge before engaging in such activities. This is it for today's video. What do you think about our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.